U.S. nat gas futures dropped below $2.60 despite a larger than expected withdrawal reported by EIA this morning. The report printed a draw of 117 billion cubic feet, much larger than the 5-year average of 48 billion, and a larger draw than survey averages of 105 billion cubic feet. The draw decreased supplies to 3,719 billion cubic feet and decreased surpluses from 303 to 234 billion. This report comes amid a backdrop of colder than normal weather across much of the U.S. Nevertheless, these bullish events don't move gas prices higher, and this is clear evidence that the natural gas market is heavily manipulated. Looking ahead, U.S. gas demand is expected to rise, with forecasts suggesting an increase from 121.8 billion cubic feet this week to 126.2 next week. Additionally, in December, there was an increase in gas flows to major U.S. LNG export plants, with record high volumes reported by U.S. export facilities. In the spot market, cold weather in New England, where approximately 54% of power generation is sourced from gas-fired plants, has led to a surge in next-day power and gas prices, reaching their highest levels since February. This increase reflects the region's pipeline constraints and heavy dependence on gas for heating. On a different note, ExxonMobil has postponed the commencement of LNG production at its Golden Pass export plant in Texas, moving the timeline from the second half of 2024 to the first half of 2025. On the contrary, European nat gas futures rose above €40 per megawatt-hour, rebounding from a 2-month low of €38 earlier in the week. This increase is attributed to an uptick in withdrawals from storage sites, surpassing last year's levels since the end of November. As of December 5, European Union gas storage stood at 92%, a decrease from 95% at the end of November. If the withdrawals continue at this rate, we will likely see much higher gas prices in Europe this winter. However, with temperatures expected to rise and a challenging economic outlook limiting industrial consumption potential, the future demand for EU nat gas may face constraints. The current trend in U.S. nat gas futures indicates a bearish short-term outlook. Mild weather conditions across major regions are resulting in reduced demand. This, coupled with increased production and high storage levels, is exerting downward pressure on prices. Despite a bullish draw in the EIA weekly storage report, which surpassed the 5-year average, these bearish factors have not been counteracted. The current daily price of nat gas at $2.55 sits below both its 10- and 50-day moving averages, indicating a bearish trend. The price is also below the minor resistance level of $2.60, further reinforcing the bearish sentiment. The $2.50 level below is a crucial area drawing considerable attention, and the question now is whether it can halt the further price decline. The current development represents another episode in the ongoing saga of nat gas. While the bulls might eventually be proven right, attempting to pinpoint the market bottom poses a challenge. If the price eventually reaches the projected levels, some forecasts even suggest above $6 or $7, initiating a purchase at $3.50 can yield substantial profits. The eagerness to buy at the lowest point may indicate a certain level of uncertainty regarding upward targets. It might be prudent to wait for significant buy-side liquidity to materialize on a higher timeframe, be it weekly or monthly, before considering a long position. Thank you for watching. Please don't forget to support the channel if you enjoyed the video. See you in the next one.